We are in the credit card processing business for retail. I'm sure you've all seen these little swipe machines. We go between this and the processor upstream, and I'll show you how we do that, and I'll show you how we accumulate cash flows in this business. We are in the business of acquiring credit card processing contracts from independent distributors. If you think independent life insurance distributors, this is the analog in our space. These are folks who go out and sell credit card processing machines and processing functionality to small retail locations throughout the United States. So if you think sole mom and pop retail stores, that's what we have in mind. To be clear, these are not buying credit card charge-offs. This is not consumer debt. So we're not doing that. I want to distinguish this between that enterprise and what we do. This is not bad debt recovery. These are cash flows that we have an established track record on. We can look back in the past for 12 months, see the cash flows, price it accordingly, acquire that, and we're paying 2 to 4 times cash flow when we buy them. We're a public entity. The public arbitrage on that is about 8 times cash flow. We're paying 2 times cash and 2 times in publicly traded stock. The merchants are set up to use the credit card terminal, and they pay a fee. The fee has a percentage in it, which goes to the sales agent, and that is known as a residual. Residuals last for the lifetime of the merchant, and our focus market is the 5.2 small retail stores in the United States. We're buying cash flow streams, and every time we make an acquisition, it generates positive cash flow to us at a very high margin because our administrative overhead is fixed. So we have a wonderful position there to add highly accretive cash flows. Quickly, our place in the universe, you see the transaction processors at the top. Around. We are a distribution channel for them over there. ISO stands for Independent Sales Organization. And we distribute to the 5.2 million small merchants and a few of the medium size, but essentially we're a roll-up play of those 2 blue boxes on the right-hand side of the screen. A typical transaction, just to give you the back room of how it works, the cardholder presents to the credit card machine in the merchant location. Again, we're the blue box that distributed and plays the intermediary role between the processor and the retailer. And then electronically, what's happened is we've created a receivable that bounces off the computer systems at the processor to the card associations to validate that the card is good, the credit limit is available. It goes to the cardholder's bank, the money goes to the merchant in the lower left-hand corner, and that's how the whole system works. Again, we're on the front end. We are the half of the credit card system that people don't really think much about because everybody knows their card bank. They know about the card side of it. They know the consumer side. They don't really know the merchant side so much. So we're really an overlooked channel. There's not a lot of capital out there. The ISOs we work with don't really have a lot of options when it comes to liquidity and value creation. So we've got a nice protectable play here. I'm Harold Montgomery. I've been 25 years in the space, acquiring these assets for the last 10 or 12 years, doing that successfully as a private company. Now we're doing it in the context of being a public company. My partner, Craig Jessen, and I have worked together for 20 years. Cynthia Bailey, our Chief Marketing Officer, has 20 years in the business. David Palat is new to the company over the last year, but has extensive experience with public company CFO responsibilities. And then I also want to mention to you that we own and publish the largest 4-color trade journal in the business called Transaction World Magazine, which circulates to 15,000 readers in our business more or less every month. And that gives us great advertising as well as editorial positioning. So I write an article in the magazine every month, and we generate a tremendous amount of response out of the magazine by laying out effectively our program every month in a format that is on the reader's desk all the time. So the investment thesis here is a very simple one. It's a roll-up of cash flow streams. Our pipeline of deals that we're looking at right now is about $18 million a year of revenue, and if we were to acquire all that, we'd have at least a 70% cash flow margin on that. We expect to close the pipeline, or some significant percentage of it. Deals kind of come and go, as you might expect, within the first year, and our goal over 5 years is to accumulate $100 million worth of net revenue with a 90% EBITDA margin attached to it. Others have done similar activities. That's not an outrageous ask. I'll show you the comps in a few minutes. The acquisitions are structured with 2 levels of leverage. Again, we pay half in cash, half in publicly traded stock. We're buying at 2 times the annual cash flow, so $100,000 a month to us, $1.2 million a year, we would write a $2.4 million check in cash, and we would give them $2.4 million worth of stock at the current market price. And the public market it gives our peer group an 8 times or higher cash flow multiple. The cash portion can be fully debt financed in our business, so we have a very high return on leverage acquisitions. We have an $8 million debt facility in place, which is also expandable, and we have a $5 million equity junior debt layer supporting that. So this is a very well-constructed balance sheet. It is not a highly vulnerable or tippy kind of balance sheet. It's very clean. It's very nice. Investment highlights. We have a unique position in the payments industry. Nobody does what we do, at least not on the scale we do it. You get garage players. It's not the same thing. We have a proven management team. We're the dominant acquirer with a strong track record. Very profitable business model, recurring cash flows, very high EBITDA, very accretive, highly scalable, senior debt line. The senior debt line is very scalable due to the fact that we put equity underneath every transaction we do. And there's multiple high return comparables, including in the market today. You'll see Heartland Payment Systems, but historically a company called iPayment, which still reports publicly because of their debt. PMT, Nova, and others have done the same thing. Here's a quick look at Heartland. It trades at 21 times earnings, has a $700 million market cap. It's an organic strategy. iPayment, again, they report publicly, so we have this data. They've achieved 140,000 merchants and an $88 million EBITDA. Other historic roll-ups include Nova and PMT. Today, we've raised, as I said, $5 million of equity and junior capital. We've closed on our first deals. We're running at about $1.5 million of annual residuals. Those are guaranteed by the seller to us for a period of 3 years. Current overheads under $3 million a year and does not increase materially as we add, so it's very scalable. We've closed our $8 million debt facility, and we have a significant pipeline out there that we're working on. How big is this opportunity? It's substantial. There are 10,000 ISOs. There's $1 billion in annual revenue that we can go after. The current deal pipeline is up to $30 million. About $6 million of it is a very near-term focus for us. After overhead is covered, the remainder falls to the bottom. The goal is to get $30 million together within the next 2 years, scaling to that larger number I told you about in 5. It's fairly low barrier to success. These acquisitions are very easy. There's no operational integration to do, no people to lay off, no facilities to close. We buy the customer base, we move it over to Calpian, it's done. They're done very quickly. We have excellent underwriting information that we get from the third-party processor. 100,000 merchants would be a total home run. 30,000 merchants is a very successful company. Obstacles to reaching this size are few. No other public players out there doing what we're doing. What are we doing? Well, it's a safe and secure loan position that we're pitching today to FSX players, a sub-debt piece with 5 to 7 times interest coverage. The cash purchase piece that the sub-debt would be used for is about 2 times cash flow. Loan-to-value is under 50%. It's a 12% interest yield paid monthly, a 2-year term plus warrant coverage to give you some pop. Here's the deal, a $10 million offering, $50,000 minimum investment. For Reg D accredited investors, it's subordinated debt, 12% paid monthly, as I said, 2-year term, and a 20% warrant coverage at $2 a share. Their shares have traded higher than that, and the proceeds are to be used 100% for acquisitions. The broker deal is a 5% commission, 5% warrant for stock at $2 a share, and we're seeking broker interest before we formally launch this to the general public. That's our presentation. Are there any questions I can answer in the minute I have left? Bill?
How close are you to the 30,000 target?
Of the ones that we have closed, we're about 20% of the way there. Of the deals that we have in the pipeline that are coming into dock, which is a process, I would say you're talking about being close to halfway there. So I feel very good about that. I'm not worried, and I don't lose any sleep over whether or not we're going to make that goal. I feel highly confident we're going to make that goal. Again, that's a judgment that comes from 20 years of being in this space, knowing where the deals are, knowing how to get them done, and knowing the pricing power and frankly the attraction of our stock to the seller audience is very high. Any other questions? Yes, sir.
Is that a due diligence opinion?
Laird? No, we do not. We're happy to provide you materials for your own investigation, however. Any other questions I can help you with? Okay, we're outside in the corner just to your left as you walk in. Thank you very much for your time and attention.